Dear investor, after 2 months of bearish markets, November has been good. There has been a big change in the macro in the month of November. Oil prices, which were moving up sharply and had crossed 85 to a dollars to a barrel, have changed direction and are today quoting at a year low of below $60 a barrel. The Indian rupee, which was depreciating and had touched 73 to a dollar, is now below 70. FIIs, which were sellers and strong sellers in the month of September and October, have turned direction and are net buyers. Given what has been the change in the macro, marketplace has responded and indices have moved up in the month of November. So, of the various issues that we spoke about over the last 2 months, one being liquidity getting sucked out of the system slowly but surely on account of FII selling and oil prices moving up. The base reasons for the same are clearly reversing. What remains is the NBFC segment related issues, which were mostly on account of ILFS event. We believe the policymakers are clearly focused on the space, both from the government side and from the RBI side. We have seen the RBI do a lot of OMOs between now and end of December. A further 50,000 crores of OMOs would be done. This should infuse liquidity into the system. There are signs of things improving. The CP market, which had crashed and the rollovers were difficult while they were done, to the extent of, let's say, 50 to 60%, is clearly opening up again. The yields on the G-Secs have softened and even corporates are able to raise money from the CP market at rates which are more similar to what prevailed 2 months back rather than what prevailed over the last 1 month. So, overall, in terms of signs from the marketplace, things are clearly seen to be improving. Dwelling a bit more on the NBFC space, we believe NBFCs provide a big multiplier to the credit disbursement into the system. They serve a good policy purpose. We believe that many of the NBFCs which are rated well, to our mind A minus and better, are into smaller ticket lending, spaces like microfinance, gold finance, two-wheeler finance, consumer finance, and maybe at the fag end CV finance, are not impacted as much. They are having manageable ALM issues. In fact, in some of these segments, they may be borrowing longer term to fund shorter term, for example, in the space of gold lending. So, in this space, we really do not see much issues cropping up. However, for the longer duration exposures in the infrastructure space and in the housing space, particularly in the developer financing space, is the space where concerns are clearly emerging. We believe, through regulations on tighter ALM, ensuring that the near term is always liquid for such finance companies would take care of such issues, and one should expect regulations to happen towards this goal. Overall, coming down to valuations, because over the last 3 months, that's a time period of a quarter that's gone by without the market doing much, and in fact being down net close to 10%. And with some amount of EPS increase that's happened in quarter two, uh, the market valuations which were seemingly high have now become much more defendable. Even with the cut in earnings for FY19 on account of lower margins that were witnessed in quarter two, and a lower growth of 17 to 18% versus over 20% growth built in the consensus numbers for FY20. We do believe that markets are trading at 17 times 1 year forward, and that is a defendable level to be at. Secondly, what has also happened is that the skewness of the market has reduced. Earlier, the high quality, high growth space was seen to be trading at significantly higher valuation versus the rest of the market. Now, because this space has seen a larger correction, the FMCG space, the retail banks, the NBFCs have all seen correction larger than what the indices have experienced. And on the other hand, metals, corporate banks, IT and pharmaceuticals have seen an uptick in the same period. The skewness of the marketplace has definitely reduced. This then kind of means that once again, as markets normalize, as the issues plaguing the NBFC sector get behind us, which we expect to happen over the next 1 or 2 months, these spaces should again start to perform in the marketplace. We are in the election season. Election for 5 states are currently underway. They will be followed by the general elections next year. We believe money flow in the system in this period is going to be high. This should help the consumption space do particularly well over this period. Our portfolios are positioned accordingly with a high focus on domestic businesses, primarily split between consumption driven businesses and financials. Thank you.